that startups still need to continue to grow.
It's really back to first principle, solving a problem and a need that exists.
One thing that will always be the soul of your hyperscaling sort of process is your team.
Last week, TimesBridge, in association with BCG and TIE Delhi NCR, launched a very fascinating report. Now, the road to hyperscaling in India. And what this document sought to do was to dig deeper into the journeys of India's late-stage startups and find out just what it takes to hyperscale in this country. Now, the document is available for download on the BCG site, and I've spent the weekend diving into it. And to chat with me about this, we've got three leaders from BCG, TIE, and TimesBridge. Please join me in welcoming Nimisha Jain, the Managing Director and Senior Partner at BCG. Hi, Nimisha. Thanks for plugging in. Hi,
I'm very happy to be here.
Thanks, Nimisha. We have Alok Mittal, the co-founder and CEO at Indifi Technologies, and also a board member at the TIE Delhi NCR chapter. Hi, Alok.
Hi, Ashwin. Good to be here.
Thanks, Alok. And we have Abhinav Bansal, the head of strategy at TimesBridge. Hi, Abhinav. Thanks for joining us.
Hi, Ashwin. Thanks for having me here.
Now, before I really dive into talking about the nuances of the report, one quick thing: what's the funnest part about putting a report like this, and what's the not so fun, sweat-breaking part of building a comprehensive, document like this one?
Maybe I can talk about the fun and Abhinav can talk about the sweat, right?
Sounds about right.
You can see who did what. And Alok, you should add on. But look, I think for me, the best part was actually meeting everyone. As part of this, we did, we interviewed over 20 founders, from different sectors, different stages. And I think those conversations were just incredibly energizing, right? I mean, just listening to what people have been through and starting to sort of pull patterns together was just very, very inspiring. Yeah. And there's always the photo finish to make sure the reports get printed on time and the I's are dotted and the T's are crossed. But I'm gonna give that one to Abhinav. I think he had to be in front of this with the sweat.
Yes, 100% on the same page with Nimisha in terms of the best part. So certainly that was the highlight. Having these conversations packed with insights with 20 odd leaders, investors, founders, and operators who have been there, done it. So that was certainly the most enlightening part of it. But again, with that comes a great responsibility to include those insights and give them a voice in the report, but do so in a very responsible and right manner. So that was, I think, a big thing that we had to take care of, that we are not misinterpreting what we heard from them and not being, so to say, unjust to their journey. So that was the most challenging part, I would say.
Interesting. And one of the founders and investors, that you're talking about is Deep Kalra. And there's a very interesting opening to the entire document with Deep talking about. And he's a veteran unicorn of an individual, or so to speak. And he talks about focusing on basics. What is the basics that you think enterprises should get right as a first step to, really hyperscaling in India? Alok, if you want to come in, because you are a founder yourself, what are these basics? Talk to us about that one.
Yeah, I think the basics have been well known for a while, right? Before you get on the journey to hyperscale, it's all the basic work around, who's your customer? Are you adding value? Do you have PMF or not? I think one of the things that has gotten re-emphasized over the last 12 to 18 months is the fact that there should be a viable business model. If not today, then there's a point of view on what that viable business model is that surfaces up as you scale up. So I think the notion of driving, unit margins, driving contribution margins, and then driving ultimate profitability in the company is certainly something that has gotten emphasized. But one of the things that was most refreshing to me about this report is that over the 9 months that we've been through, so much of the media and even some of the investor narrative has been around the funding winter and how everyone must hunker down. I think this report just brings all of that conversation into perspective, that startups still need to continue to grow. That is the fundamental reason, why startups exist, to solve a problem and solve it at scale. And while doing that, they need to start to, revisit their premise around profitability. Are they really adding customer value and hence the ability to command that value? But I think it does shift the narrative from all doom and gloom to back to saying, hey guys, we are ready for growth. Right? We know we have had to make a few adjustments, but India is still the most attractive market to be in.
No, hunkering down and unit economics are definitely on the agenda of the things that I want to talk to you about, and I'm going to, deep dive into that in a little while. I want to come back to, Nimisha at this point of time. Nimisha, talk to us about the basics that you think the companies should, keep firmly in focus.
I'll build from where Alok, Alok left off. I think, really it is about understanding a core consumer customer need and solving a problem, right? It is, it's really back to first principle, solving a problem and a need that exists. It could be a friction, it could be an unmet need, it could be, solving something better than anyone has done before. And there's different angles to come at it. But I think if you solve for core need and deliver distinctive value proposition, that's really the starting kernel and the most important foundational block. And then, you do it in a manner that delivers, good unit economics, because doing this, there are no free lunches, and the last few quarters have shown that, even more starkly. So how do you then, use this and deliver this in a manner that actually delivers value? And look, I've been tracking consumer behavior for a couple of decades now. What I can tell you is consumers across the world and in India in particular are actually very happy to pay for real value. So it's not that you need to discount. You can actually get value out of it. You have to think creatively and differently about making this happen. Yeah.
But listen, there are Bangalore startups who will say that free lunch attracts great talent. Yeah.
That's fair. But
Abhinav?
I could see you were waiting to say that, right? Free lunches can attract customers too, but I think the question is for how long.
We will talk about that in just a moment. Abhinav?
I think, yes. So again, just to add to what Nimisha and Alok said, two things stand out for me. One is team and talent. So no matter which part of your journey you are on, whether you are on your 0 to 1 journey or your 10 to 100 journey, one thing that will always be the soul of your hyperscaling sort of process is your team, your people. So how do you design an effective organization structure around them? What is your culture? What are your ethos and values? Which, by the way, have to remain intact and kind of constant. The way they demonstrate themselves and manifest themselves will change stage to stage. But yes, I feel team and culture is a very important aspect of keeping sort of track of when you're hyperscaling. And the other bit is, again, picking up from Nimisha and Alok. And I've heard Alok say this a couple of times in the past, and I'm a big fan of this particular insight of him, that growth and profitability have to walk in harmony. They are not at loggerheads. You have to understand that. And while, of course, you have to be focused right now in the current environment, it's no excuse for you to give up on the growth of, let's say, at least your core business. So you have to keep on growing in a more frugal and smart way, but it's not a trade-off always. Both can walk in harmony.
You said frugal, Alok said, hunker down, and Nimisha said no free lunch. Now, one of the larger facets in the document is that how hyperscaling depends on, leveraging capital optimally. And here's the SaaS world, right? And you have ideas and startups to cater to nearly every need, which means logically speaking, you should be able to keep costs really under control and use it only as required. But yet, this theme is such a large theme about trying to use your capital effectively. What are some of the larger challenges that you still see around capital management that leads to unrestrained runoffs? Not just free lunches, but what else is something that businesses should keep a tab on? Alok?
Yeah, I think these are matters of choices, right? If we were sitting in a 2021 financial market, the answers would be different. But I do think that there are a couple of areas which in this market entrepreneurs must look at and prioritize or recalibrate. One is, capital goes towards several goals, and disproportionate capital sometimes goes in accelerating customer adoption itself. So you're making an investment in the market and not necessarily in capturing share of the market. I think that investment will need to get recalibrated, where companies might say, okay, I'm happy to go after customers who are, at the cusp of adoption. rather than going to customers who will adopt over the next 2 years, 3 years, and making them adopt this year. Right. So I think that is one piece of investment that can be made in bull markets and can be pulled back in a market like we are seeing today. I think the second piece, and this appears in the report quite comprehensively, is leverage through partnerships. So again, in a capital-rich environment, sometimes there is an instinct to go out and build full stack, and there is a place for that. In an environment like today, one way that capital can be used more efficiently is to recognize the potential that partnerships have in creating the complete customer value proposition, not necessarily build everything on our own. And even if some of those are not permanent decisions, certainly thinking about how to phase own build versus partnerships can lead to a more efficient deployment of capital. So I think there are those levers available, but it's not an absolute rule, right? Tomorrow, if the market turns back to being a $40 billion VCP market, I think as entrepreneurs, we will take different approaches to building our businesses.
Just on the first thing that you were talking about, are you at some level insinuating that brands or rather businesses are confusing brand marketing and performance marketing and going at one a little too earlier in their cycle in order to acquire customers?
No, I'm distinguishing between capturing market share versus aggressively growing the market itself. So for example, when you go to customers and say, okay, if you adopt early, I'm going to give you a 500 rupee discount.
Okay.
Right. As against going and saying, okay, there are already 20 million customers who, are willing to adopt this, and let us get the maximum share out of those. Right. And these phases of, excessive capital flow are great in accelerating markets, right? We saw that during the dot-com boom where a lot of capital came in. In hindsight, many would argue that that was wasted, but it led to a sharp increase in adoption rate of the internet, right? Similarly, if you look at, food delivery business, during the 2016-2018 timeframe, there was a lot of investment in the market that accelerated customer behavior, right? So there you are going and saying, I'm going to accelerate market adoption and not just taking share from the market. That's the distinction in my mind, not brand advertising versus performance.
Lovely. Thanks for that example and clarification, Alok. Nimisha?
I think in every business there are choices, right? One needs to make, and capital allocation is exactly one such choice. I completely resonate with Alok's point on what is are you driving adoption and growing the pie versus capturing share. But I think there's also a choice around the pace at which you want to grow, which gets linked to that, right? So. Depending on how much capital you have, I think there are some must-dos, there are some nice-to-haves, and some things that are not good to do. And then, I think the things that are not good to do, one should not do irrespective, right? Irrespective of how much capital is available. But there is that zone between, must-do versus good to do or nice to do. And that nice to do often is about the pace of growth or about, insourcing and building internal capability on certain things rather than partnering. So I think it's really about timing, and the timing, while we end up thinking a lot about the external environment, it's also about internal readiness, right? I think once you have your product market fit right, once you know that you're really truly able to delight customers and provide a very distinctive proposition, you then have the confidence to go after that and accelerate. Whereas there are periods where you're still waiting to fine tune that, and then that's not a good time to do it. So while hyperscaling is important and is exciting, I think doing it thoughtfully is very important, and therefore picking when you actually when you deploy the capital you have and for what purpose.
You're calling for patience. How hard is that?
I think thoughtfulness. I know not necessarily patience, but just being more choiceful. I think about when you do what. Yeah.
Fair enough. Abhinav?
Yeah, so I think there are two ways to think about it, how to deploy capital and how much, when, where. So one is, of course, a period when things are much better, like interest rates are low, the ecosystem is flush with liquidity, all of that is hunky-dory. So at that time, of course, it doesn't warrant you to spend on random projects, but it does give you a leeway to be more liberal with experimentation and, let's say, investing something into your moonshots or other bets. So that is the time to do that. And also you want to maintain your market share during that time. So that's one approach, depending on that kind of environment. And then there's the second kind of environment, which we are more closer to today, where I think the key is to, and also as our report states very nicely, it's to cut the flab, but grow the muscle. So you still have to keep investing in your core areas. You still have to respect your core investments and core costs, but then you have to be more sort of thoughtful and expect higher ROI on your experimentations, sharpen your KPIs. So yes, like you need to really zero in on your core KPIs, track them more judiciously and more closely, and be a little more, let's say, a little more stricter about what you're doing on the experimentation and the discretionary front.
Fair enough. And Abhinav, just stay with me. You spoke about talent a little while before, and this is one of the themes that I found to be extremely recurring in the entire report, which is unit economics and talent. Help me distinguish, how is the larger ecosystem really faring when it comes to both unit economics and talent? And what are the hyperscalers doing right? How have they managed to solve issues in this place in an innovative manner?
Right. So if I talk about talent and broadly just focusing on startups here, maybe a little bit on early stage as well as growth stage startups. So the ones which have been successful with the talent side, they have ensured again the right kind of KPIs. So and ownership. So for example, they would have many founders or many CEOs heading different verticals of their business, and those businesses would be at different stages of their own life cycles, right? Hence, the KPIs would be different. And accordingly, everything right from your performance appraisal to your goals would be aligned to the stage of your particular business unit. So I think that is one good thing that successful hyperscalers are doing well, to have distributed leadership, to have very strong sense of ownership, and not having a blanket approach to expectations on performance and KPIs. So that's one bit. And then there's always a debate which is getting more prominent these days, is how do you strike that right balance between generalists and specialists? So that is again one interesting theme that came up. So when do you hire generalists? And is the hypothesis that strong generalists can lead a team of specialists well? Is that correct or not? So in your 0 to 1 journey, you would probably need hustlers and generalists. But then, for example, in the case of Zepto, it came up that they had a very hard problem to solve, given they needed both hustlers in the 0 to 1 journey. But since it's such a technical and executional excellence focused product that they needed specialists too in the field of supply chain and logistics. So how they made that best of both worlds situation possible, and how they attracted the right talent and are now retaining it, was a really interesting case study on this front.
Lovely. Thanks for that. Alok?
So I think, again, I'll go back to the basics here, right? Why is the talent that you're attracted towards you? I think that's the core of the question in my mind. And at early stages as founders, all of us are, much more naturally attracting talent towards a mission that's relevant to them, right? We'll go out, we will sell to the talent, we will tell our vision. And as the company scales, a lot of the recruiting goes down the line, recruiting department does a lot of that. And hence the relationship with talent becomes more transactional than mission driven. I think this is a great opportunity to, recapture, that mission oriented attraction for talent. I think all of us will need to engage more strongly with teams that we already have, not just attracting from outside, and make sure that they remain excited about the future that we are creating. And then I think there is a lot of tactical stuff that captures the limelight, when money is easy, BMW bikes and cars and so on and so forth. So there is a war for talent out there. And, I don't doubt that some of these things help you gain a tactical advantage, in that war. But I think we will see a lot more, deliberate behavior on part of founders and extended leadership teams, right? When we're talking about these large companies, it's not just the founders, but also their larger teams. just making sure that talent continues to be attracted towards the most interesting problems to solve, right? There's a market for talent out there.
It's always been a market for good talent. That problem doesn't seem to have been solved over the last 1-2 decades anyway. Nimisha, what are you advising, your clients when it comes to, well, unit economics and the talent problem?
Let me start with talent first, right? I think like both Abhinav and Alok has said, talent is super critical. Having the right people and keeping them engaged and motivated is probably the most important. If I just look back on all the conversations that we've had, and one of what came out as a very consistent theme throughout is not just about getting the right talent, but how do you keep them, motivate them, grow them over time, and how do you build a level of dexterity where people are actually sort of moving across roles, right? Especially in this journey, because many of the founders talked about how some of their best people had first helped to build out one thing, then helped to solve an operations problem, because that's what was starting to hurt now. And so they all have like this cadre of their sort of go-to people who then sort of jump from solving one problem to another. And I think that's it's actually just an incredible approach. It's not what conventional organizations do, but I think it builds both a very different caliber and a different level of dexterity, but also keeps people very motivated because they feel like they're actually learning so much more rather than only doing more of the same, and that gets them energized. While a lot of focus ends up being on the inflow, I think an equal, if not more, focus needs to be on how do you actually construct career paths, how do you keep people motivated, because that and how do you help them grow, because I think that's what really becomes very, very distinctive. Yeah. And I think at in early stages, it's easier to do that because you're all sort of in it together. But what many of the founders who've gone through the 10 to 100 journey said is that how do you now do it beyond that, that first layer or those, 10, 20, 30 people who are part of the initial team. But how do you actually continue to drive that spirit of entrepreneurship and ownership and eagerness, even with a much larger organization? And I think that's a very important question that's on their minds. And now switching gears to unit economics, which is something that, everyone wants to talk about. I think that, I'd say a couple of different things, right? At the one, which I was touching upon earlier, getting the right, getting the product market fit right and getting the value proposition right is super critical, because, anything that is more of the same, anything that's me too, becomes very difficult to be able to distinguish on. And then, it's very easy to get into a price war with somebody. So being distinctive, I think, is super important. Secondly, if we look back on successful examples of hyperscalers who've been able to build positive unit economics or good unit economics, the one consistent theme is that they've created profitable moats. Now that could be about certain kind of distinctive supply that they've created, something distinctive in the in the operating model that is there, access to certain kinds of resources. So it could be, it's different aspects of the operating model. A lot of founders have invested early on in really, creating supply in a category that didn't actually exist because there was no level of standardization. A lot of small suppliers didn't actually have the, didn't have the knowledge. One of them told us how they actually taught them how to use Excel and, do inventory management and, and so on and so forth. So there's a lot of, just education capability building that was done to pull together a fragmented universe of different stakeholders. And using that created a very distinctive moat. And I think these moats actually help to build positive unit economics. So you have to play the long game. If I were to put it in one word, really distinctive value proposition and also, distinctive advantage in your operating model, which can then, take you through and you don't get into, unnecessary price war. Yeah.
And let's stay with that value proposition thought. Nimisha, one of the things in the report that I saw was that, well, it's a fact, of course, in India at this point of time, we have over 100 unicorns, a whole bunch of soonicorns, you have 40,000 startups. In terms of value propositions or in the quality of ideas, how many of these do you think have the potential to hit the unicorn space? And do you see any sectors where you expect this magic to come from?
I think many of them have, right? I mean, I've observed many, worked with several of them, been closely involved in many. And I think many have the opportunity to do that. Some have already hit a very high level of distinctiveness. Some are work in progress right now, and it's a journey. But I think keeping both things in mind together is super important. You need to keep refining the value proposition, which means you need to stay very close to your consumer. You need to be listening to the customer all the time and say, what can I do to make this, to deliver better proposition and deliver better service levels. And at the same time, continue to invest in layers of advantage and continuing to invest in it over time. So if I look at, startups that have become unicorns, even sort of much larger, decacorns or close to that, they don't stop with their first layer of advantage. Their first layer of advantage may have been because they had, vertical integration or a different kind of supply. The second layer might have been because they were able to access certain kind of storefront. The third layer is now because they've got now large customer bases, the power of analytics is allowing them to do something. So you keep building on top and you stay paranoid throughout and don't get complacent. I think that is just really, really critical. And when I look at just the way some of them have done it, I mean, it's incredibly inspiring, I think, for everyone else.
Paranoid, interesting way to get into action. Alok?
On the unit economics front, I think the only other thing that I would add there is, there's a fair bit of distraction that comes into, what is unit economics when the markets are good, right? This is like a kid walking into Las Vegas and saying, my value system doesn't allow me to gamble, but, this is just a trial and this is just a free gift. So I think there's a lot of emphasis I would play on founders not drinking their own Kool-Aid. Right? There are many ways to game this. So I think there are many ways to game this. There is a metric around GMV, but we haven't really delivered the GMV. But so what, right? There's a bunch of distraction that comes into it. And I firmly believe that as founders, we need to keep our senses focused on what is truly giving us the evidence that this business can make money, right? Not for other people, but for ourselves. We are investing our time into it. That's the most valuable investment. So that's the only thing that I would add, because I've seen, us as founders getting distracted with the investor narratives, with the media narrative, and in almost, some sense, create a version of the unit economics that is not representative of, how money gets made in the market. Other than that, again, as Nimisha mentioned, I feel very comfortable and optimistic about companies that are out there, claiming the unicorn tag or not claiming the unicorn tag, but unicorn tag, those are just labels, right? When you raise a $400 million round, it's not that hard to be a unicorn. The question to me becomes, okay, what is the return on investment that you have generated, right? Are you worth 5 times the cumulative funding raise? Are you worth 10 times the cumulative funding raise? Or are you worth 2 times the cumulative funding raised, right? So it's almost that is a more important parameter for me. But both in terms of market spaces, that opportunity continues to be compelling, right? So India to the world, SaaS marketplaces continue to attract significant capital. We are seeing fintech and within that lending continue to expand actually in terms of capital that they can raise. So there are several large categories that continue to be available for disruption or just as white spaces, where I think the momentum on building relevant and scalable businesses will continue to be there.
Got it. Thanks for that, Alok. And closing notes from you, Abhinav.
So yeah, it's very interesting to think about or forecast the number of unicorns that we may have, let's say 3 years down the line. And there are enough interesting public sort of estimations on that. Someone says that we'll hit 250 unicorns by 2025 and so on. But again, we need to just introspect and decide what is the right milestone to chase. So is unicorn tag like a great, again, step towards your eventual journey, or is it the end game? So of course, while the unicorn tag has its own importance, but it doesn't have to be an end game. It's just a means to get to the end of a long journey that your business has. So that's one. And I think in terms of the startups or businesses best placed to, for example, attain this tag and level, are the ones who create products in India for India, whether it's for Bharat, which is your audience in tier 2, tier 3 towns. So of course, you take inspirations from global companies. You follow the standards that some of them have veritably set. But at the same time, if you are, whether you're thinking in a very localized and in a culturally sensitive way or not, that is going to be key. So it's now high time for us to really capitalize on this massive digital market that is also growing at a great pace in India. So we have a very strong domestic consumption economy. So it would be great for startups to focus on that and build solutions locally, and also for the world, for other emerging markets as well, if some learnings can be taken out from India to those markets. So that's my thought on that. And coming to the second part of which sectors seem well poised to create some of these hyperscale companies. So I would say deep tech, one that really excites me a lot. That's in early stages, and that's relatively insulated to the vagaries of the funding environment, I would say, because it's just investors are beginning to fund that innovation. So it's a very long-term horizon game, and the upside is infinite. So I think there's a lot of enthusiasm in the VC ecosystem regarding all things deep tech, and still full sort of willingness to fund and mentor that ecosystem. Beyond this, I also see a lot of activity and upside in sectors such as gaming. So we now have 500 million plus gamers, but how to create again monetizable and sustainable business models around this massive gaming user base. So how to move from just being a user-based market to a revenue-based market. So that's a great opportunity waiting to be tapped. And a few other sectors like media, agri-tech is also gradually having its moment in the sun. So yes, these are some of the sectors beyond the regular e-commerce, fintech areas that are very exciting for the next few years.
Lovely. Thank you so much for your time talking to you about the road to hyperscaling in India, the report that just came out recently, talking to us about what it's going to take for Indian businesses to hyperscale in the current environment. Nimisha Jain, Alok, Mittal, Abhinav, Bansal, thank you so much for your time today and joining us here on Business Insider India to talk about the report. For those of you watching, the link to download the report is down there, and we urge you to download, take a read, and understand just what the businesses are going to be doing in the years to come. On that note, once again, thank you so much, Nimisha, Alok, and Abhinav. Have a great day.
Thanks so much.
Thanks, Ashwin.